In many ways, SPYI, the NEOS S&P 500 High Income ETF, takes a smarter approach to managing a high-yield covered call ETF than its competitors like JEPI and XYLD, but not in every way. This is Ethan. I'm a CFA Charterholder and investment professional, and today I'm going to show you how SPYI works, how I would expect it to perform in different market environments, and how it compares to alternatives like JEPI and XYLD. Oh, and as a bonus, toward the end, I'll share some very interesting drama I uncovered in my research that went down between the portfolio managers of SPYI and some of the most common high income ETFs in the market. Let's dive in. At its most basic level, SPYI is an S&P 500 covered call ETF. If you already know what that is, you can skip ahead about 45 seconds to the next chapter. For those who need a refresher, we'll start with that. What is a covered call ETF? In a nutshell, it buys stocks, then writes, or sells, which is the same thing, call options on them. A call option gives the buyer the right to buy a stock at a set price. Of course, they'd only want to do that if the stock price went higher than that price. So if you're selling those options, like SPYI is, that means that someone else gets to benefit from the upside in the stocks if they go up a lot. So to recap, SPYI buys stocks, then sells call options on them. That means you get a little of the upside potential, but then anything beyond that set price, which is called the strike price, you give up. And what do you get for giving up your upside potential? A juicy yield. And that is the main reason why people buy ETFs like SPYI. Right now, it's yielding about 12%. Now that you've got the basics down, let's dive a little deeper into how SPYI is managed, since it differs from the typical covered call ETF in a few important ways. First of all, SPYI is actively managed to keep the income relatively consistent. This greatly improves on one of the weaknesses of most other covered call ETFs, the inconsistency of the income, where the monthly distributions of SPYI in blue, XYLD in orange, and JEPI in gray since the beginning of 2023. Don't worry about the level. Those are all on a per share basis, and these ETFs all have different share prices. What I want to show you here is the consistency. SPYI's income has remained pretty consistent around 48 to 50 cents per share, whereas XYLDs and JEPIs have bounced around like crazy. By the way, if you're wondering why SPYI and XYLD's yield spiked up recently, but JEPI's didn't, that's because they both pay out in late August, and JEPI pays out in early August. There was a ton of volatility at the beginning of August, and higher volatility means higher income for covered call strategies. But since JEPI had already made its August dividend payment, that heightened volatility won't be reflected until the next one for that. Okay, back to how SPYI is managed. They achieve this greater consistency in their income payments in two ways. One, they can either increase or decrease how far out of the money the call options are. And two, they can adjust the percentage of the portfolio that they write options on. Typically, they write options that are about 1 to 4% out of the money. That means that if the S&P 500 is up, investors can get 1 to 4% appreciation over the option period, which is usually about a month, before its returns are capped. Options that are further out of the money give the ETF more potential upside if the market goes up, but also provide less income. Typically, they write options on about 75 to 90% of the portfolio. The more of the portfolio they sell options on, the more income they will generate, but the less potential growth will be left. As a reminder, when you sell a call option, you give up your upside. So if they sell options on 80% of the portfolio, that means 20% of it is left with the freedom to appreciate without being capped. That gives it a second advantage over other common call ETFs like XYLD. It's managed to allow some appreciation. Not a lot, but it's better than nothing. They do that by selling out of the money calls and by not selling calls on the whole portfolio, like we just discussed. XYLD, for example, sells calls at the money and on the whole portfolio, which should lead to more income in the near term, but basically no chance to sustain that income in the long run, unless you're reinvesting all the dividends, which unfortunately most investors don't do. An interesting wrinkle that I haven't seen in other covered call ETFs is the ability to use call spreads. Basically, that means that in addition to selling a call slightly out of the money, they can also buy a call even further out of the money. They're not likely to do this often, but where they might do it is if the volatility in the market was unusually low and it was just consistently grinding higher. When volatility is really low, options are really cheap, which in this case means they wouldn't be able to generate their target income without selling calls pretty much at the money and on most or all of the portfolio. But if they did that, then they wouldn't be able to capture any upside potential, kind of like what XYLD does. So, to solve that problem, they can buy a call option further out of the money as a cheap way to give investors more upside potential in that environment. It would work something like this. Instead of a normal month where they would just buy the stocks and then sell a call option, say 2% out of the money, meaning the ETF would forgo any of the S&P 500's gains beyond that, they would also buy a call option, say 5% out of the money. That would allow them to start recapturing the upside of the S&P if it went up more than 5%. A third advantage over other covered call ETFs is that it's managed to be more tax efficient. They do this in three ways: buying individual stocks, selling calls on the S&P 500 index, and active tax management. Only a small portion of the income comes from the dividends on the stocks, but for the most part, those are qualified dividends, which are taxed at a maximum rate of 20%. And really, only 15% for most people and zero for some. As I'm creating this video, some politicians want to change that next year, but at least in 2024, that's the case. And you can always go to the IRS website to find the current rates, even if you're watching this video 10 years from now. The second part that makes it more tax efficient is selling options against an index. It may seem like that's what every covered call ETF does, but it isn't. When you sell options against an index itself, like the S&P 500, instead of something that's simply linked to an index like an ETF that tracks it, 60% of the option income is usually taxed at the lower long-term capital gains rate, and only 40% of it is taxed at the higher short-term capital gains rate. If you're in a high tax bracket, that can be a big advantage over something like JEPI, which uses an equity-linked note, resulting in 100% of the income being taxed at the higher short-term capital gains rate. The third way they reduce taxes is through active tax management. The simplest way I can explain this is that there are often many things in the portfolio that are up and down at any given time. They're able to, quote, harvest losses, which basically means that they are able to marry up something that's at a loss with something that's at a gain as they're selling, which allows them to classify some of their income distributions as, quote, return of capital. When they do that, the portion of income that you receive as return of capital is not taxable that year. You will have to pay taxes on all your gains eventually, but this process can allow long-term investors to defer some of the taxes until later and actually also potentially pay the lower long-term capital gains tax on a higher percentage of their overall gains. As a reminder, gains on investments that are held for more than 1 year generally receive that lower long-term capital gains rate. The one key disadvantage versus JEPI, in my opinion, is that it has higher volatility underlying holdings. JEPI is actively managed to achieve a lower volatility profile, so it doesn't just own the blanket S&P 500 like most others do, including SPYI. Volatility is very important in an income strategy, and it's especially important in a covered call strategy since there's such limited upside and it's so much more difficult to recover from losses. Where these would do well is in relatively flat markets. Where they will struggle mightily is in highly volatile markets, since they capture all the downside and give up most of the upside. Sure, income would be higher in highly volatile environments, but your investment will dwindle away over time unless you reinvest the income. Since most people don't want to do that, I'm generally not a fan of any covered call ETFs, but overall, I think SPYI is the best approach I've seen to date. That brings us to our final topic, which is sure to be the best part of this video. Check out what I discovered when I was researching this fund. Okay, so let's start here. These three guys, Garrett Paolella, Troy Cates, and Taeyong Lee, hope I didn't butcher any of those names, they started NEOS in 2022. When you look at their bios, and we'll just use Garrett for example, it says he's been with all these different companies: Arvis Volatility Management, Horizons ETFs Management, Recon Capital. And so I thought, why is this guy bounced around so many times? Has he launched a bunch of ETFs that ended up failing? Is he scamming people? Like, what's the story here? So I did some digging. He founded Recon Capital in 2012. Then in 2016, he sold Recon Capital to Horizons ETFs Management, which was the subsidiary of Mirae. All of this is consistent with what it says in his bio. But look what ETFs he was managing. Different names, but do you recognize the ticker, QYLD? That's the $8 billion Global X NASDAQ covered call ETF, Global X, by Mirae Asset. He started QYLD. Now, you may not recognize the name or ticker of the bottom line, Horizons S&P 500 covered call ETF, HSPX, but you will in a second. If you look at the fine print on XYLD's fact sheet, you can see that XYLD traded under the ticker HSPX until August 2020. So he also created XYLD. As I was reading XYLD's fine print, I also noticed the next line. The fund's investment objective and investment strategies have changed not once, but twice in December 2017 and August 2020. Well, wait a second. 2017, that's right after Garrett and his partners sold Recon to Horizons, which was part of Mirae, right? And now it's under the Global X brand, which is also part of Mirae. But Garrett's team is no longer there. So what happened? More digging brought me to this article from investmentnews.com, which was the key I'd been looking for the entire time. Bevan Kelly, the former CIO of Recon, filed a lawsuit against his former partners, Barrett Paolella, Troy Cates, and another guy, Ray Bartos. Garrett and Troy are two of the three founders of NEOS. His claim was that HSPX, which is now XYLD, beat its index by, well, the details aren't important, but remember, the title of this article is How Passive is That Passive ETF? So the basic claim, if I could sum it up, is that they were secretly actively managing the fund when claiming it was passive, which made the prospectus, quote, materially false and misleading, et cetera, et cetera. What terrible people these portfolio managers are. How dare you beat your index? What investor would want that? Okay, all jokes aside, he recommended that HSPX change its index in December 2016, but his complaints and recommendations were dismissed. 6 months later, he hired a lawyer and filed a whistleblower complaint with the SEC. And 6 months after that, it changed its index, and the people who started the original versions of QYLD and XYLD were out. Then they rebranded HSPX under the Global X name in 2018. The lawyer called the lawsuit a baseless attempt by a disgruntled former colleague, and while I wasn't able to find anything on the outcome of the suit, I'm inclined to believe that. There are two key takeaways here. One, if you've watched this video up to this point, you know that the active approach SPYI takes is actually one of the things I think makes it a better approach to managing these kinds of ETFs than any of the others that I've seen. I would expect it to be more tax efficient, provide more stable income, and a little bit more upside potential than most other S&P 500 covered call ETFs. And so far, it has, at least compared to XYLD, JEPI, and Devo in the year and 11 months since its inception. This should go without saying, but 2 years is not a long enough time frame to evaluate a strategy, and it's never been tested through a downturn, so take this with a grain of salt. But based on my understanding of how these strategies are managed, I would expect that in the long run, it should outpace XYLD and JEPI, although JEPI may have the edge in a downturn. The second takeaway goes back to the strategy changes on XYLD. A lot of people in the comments on my JEPI videos, FEPI videos, and others know that XYLD buys at the money calls, which severely limits its upside. However, did you notice that they didn't start doing that until 2020? Depending on where you're watching this might be too small to see, but at the top, it shows that their first index was the S&P 500 Stock Covered Call Index, which you can see on the bottom left, sells out of the money calls. Back to the top section, you can see that the index they used from 2017 to 2020 has 2% OTM in its name. So That one seems self-explanatory enough for me to not waste my time looking up the index definition. Obviously, it sells calls that are 2% OTM, aka out of the money. And then you can see the definition of their current index, the CBOE S&P 500 buy right index on the right, which buys at the money calls. It's only used this strategy since August 2020. What that means is that some of the upside it achieved in the first 7 years of its existence is unlikely to be repeated. The period after August 2020 is a better reflection of how it's managed now. I don't know how many other finance YouTubers will go to the length to look up old lawsuits, fact sheet fine print from related strategies, and historical index definitions, but I will. If you appreciate analysis from an actual investment professional that goes deeper than, hey, look at this juicy yield and 3-year performance, hit that subscribe button. And if you'd like to continue the investment conversation with my partner Kyle and I, click on the link in the description to join our free Discord. We'll look forward to seeing you in the next video.